Good day, all. Ira Epstein of Linn Associates with your SPDR ETF wrap-up for this Monday, and we are now at the 26th of October, 2020. Interesting day. A sea of red behind me today, as you could see. We walked into an explosion of COVID cases across Europe and the United States, setting records in many different areas, shut-ins happening again, talk about more of it. Added to the confusion, of course, was the lack of the U.S. reaching any COVID relief bill between the Democrats and the White House, let alone even getting it through the Senate. So you can write that off until after the election. You'll get something afterwards. It depends who wins, what the parties want to do, and where you're at. So don't believe for a moment Mr. Mnuchin and Ms. Pelosi when they say we're getting closer. Closer on what? You probably have a lame duck Congress that has to wait for the next group in there. So who knows what's going to happen? That's how the market analyzed it. This is also the last full week of trading before the elections come in. So the polls are going to sway people. What's going on? Everybody's working very hard. And now they have to start looking at what's going on, and the volatility picks up. I've warned you that the futures firms are already on the futures side of the game, and that does impact, obviously, your QQQ, your SPY, all these markets. They're raising margins. They're even doing it in gold and silver because the volatility has picked up. Not to be unexpected. That'll all change after the election results come in. I don't know when we'll get results. Tonight you're going to get Amy Coney Barrett from the Barrett. I keep saying Bryant. Amy Coney Barrett sworn in. It looks as though she'll breeze right through the Senate vote, and then we'll have a new Supreme Court justice, and she's going to have her hands full. As you can imagine, this election is going to be a legal nightmare. But let's take a look at what we've got. We have a marketplace in XL technology that has been coming back down. We had a gap that got filled back here, and the trend has been down. What defines a trend? Well, the pattern that a chartist looks for are, if it's in a downtrend, lower highs and lower lows. I developed years ago a study called Swing Line so I could visually see that with the same rule applying all the time. What happens to chartists is they'll look at a chart pattern. Oh, that's a cloud. That's a dog. That's an inverted head and shoulder. Wonderful. Which one? Because it changes. Swing lines don't change. There's 5 rules that make it up. I wrote it, so I'm fairly familiar with it. And I'm looking for a pattern that's there that makes sense. If it's a downtrend, lower highs, lower lows. What's the risk associated with the pattern? Well, if you're going to keep a bear pattern, you don't want to take out the last rally high. If you do, you'd have a lower low and a higher high. So the risk is back to 118.76. I filter it. I look at where it's at in relation to key moving averages. Moving averages give me a bias in a market. When a market is over the 18-day moving average, I have an upside bias. When it's under it, I have a downside, and if it's just trading right against it, I have no bias. In this case, the market, if we take away today's action, you came in today in a pattern of lower highs, lower lows. You were under the 18-day average by 70 cents, so it's not just trading against it. The trend is down. If the market's got support on moving averages, since you're under the 18, it might be the 100 at 111.99. The resistance is the 18-day average, and you don't want to clear that high. It's fairly laid out there. What else do I look at? I look at Bollinger Bands. The reason I look at them is this algorithm is designed to keep the market trading within it 95% of the time. It adjusts to the market conditions during the market. My rule of thumb is the first time you hit a band, you're coming out. Nothing wrong if you're in an uptrend, buying again, looking to see what happens again. But you're only going to stay over that band 5% of the time. Same thing if you come down to it. So on a day like today, the market gets down to 114.43, and the band intraday, I was watching it. It was actually, I believe, hit intraday. 114.40, you're pretty close. I then look at momentum. And the momentum in the chart is measured by slow stochastics as oversold. So you're getting down to a spot where I personally think you've hit your downside target zone. You're oversold in a downtrend. I think that the oversold and that combination is enough for the pros to take some money off the table. Well, do I think they're going to sell on the rally? No, not while the market's still oversold. SMH is different. SMH is not oversold. You don't have a reading under 30. If you come back to the XLK, your reading's 27, so it's oversold. This isn't. So I see the argument where the pros would be looking at this market, maybe it's selling short on a rally. Now let's go to Friday's action. On Friday, you never did have a close under the 18-day average. So even though the swing line is down, the bias wasn't down. The first time the bias has been activated to the downside is today. So I can make an argument that the pros are looking to sell short at that 18-day average. They don't want to see prices over 189.09. And if they get a trend that lasts, they'll look for wherever the Bollinger Band comes in. In XLI, it's the same thing. Up until today, you had a pattern of what? Lower low and a higher high. With today's action, you set up lower highs, lower lows the first day under that number. So I can make an argument that I think the pros will sell short into the 79.98 area, stops over the 81.42. Maybe they can get down to that lower Bollinger Band. Momentum is down, bias is down, trend is down. XLE, the energy sector. I don't see anything here. Why? I see a pattern of a lower low and a higher high met by today another break. I'm not seeing anything develop there at all. To have a trend, I need the swing line to do something, or I need control to be taken on the market by the slow stochastic doing what we call embedded. I'm not seeing that here at all. QQQ. Let's take it how it looked coming in. You still hadn't had a close under the 18-day average. What the market did today is it opens higher and then it drops down. Very surprising to me that the market was even able to open higher because we saw other parts of the indices all lower. Once that occurred and you took out the lows of Friday, you had your outside day down. So now the momentum down, the trend down. You still don't have a reading under 30. When you reopen, you've got always look at your slow stochastic. If it's under 30, I think you take the selling power of the bear away. That doesn't mean the bull gets it. It just means the bear's not going to defend his position. On this chart, an interesting event could happen if tomorrow, that's Tuesday or Wednesday, you take out today's high of 285.29. From the way that I chart, if that happened, it puts into play the upper Bollinger Band. If that happens, the stop would be back under the low here or whatever the lower low is until that occurred. I am not saying that's going to happen. I am saying that if you rally and your readings go into the 33, 34, 35, the bears will probably try to defend that 284.47 with the stop over that number. It's a guess. I don't know. EFA, as far as I'm concerned, short should have been covered. You had a combination of the 100-day average, the lower Bollinger Band, and your readings under 30. Bye-bye. Game over. Now, what was the trend coming in? That's where it's interesting. You've had the lower highs, and you certainly see the lower lows. You had a settlement under the 18-day average on Thursday. So you activated the downside and I think the bear play was activated unless you take out this high, which you didn't do. So I think the bears came out of that market today. GLD, why be involved? This is called wasting your time. There's no trend there. Make up one, but there's no trend at work. You're not staying over or under anything. Momentum is down. On the very settlement today, the bias is down. Trend, I can argue it's down with a stop over 179. I guess 179.20 would be the number. I find a pattern like that, when it gets that narrow, it's called a pipe. And when I label that a pipe, it means it's like a spring in a pipe. You're winding and winding and you don't go anywhere. You try to break out one way or the other and you get stepped on. I've been there, done that. I used to have darker hair. The gold miner's still bearish. Pattern, lower high, lower low. Let's take away today's action. There's nothing that's been bullish here. That's bearish action, not oversold. Downside target, if it can continue, lower Bollinger Band. We'll see if it does it. If you took out 40.41, that would break the downtrend. Too oversold, in my opinion, to see the pros wanting to add to any shorts. I think they're in a get me out of short mode now. TLT, when we got down here the other day, this is how you were looking. No trend, I want to make that clear. A higher high, and with this day, I didn't know where the lower low is. I thought you'd hold better the 200-day average. You didn't. I'm sure I said that in my reviews. Then you go down here and what would I say the first time you hit a Bollinger Band? I think the pros are covering shorts. I certainly didn't expect this to happen, but it did. Now the resistance is here. Are we trending? No. You got a higher high, lower low market that's oversold in a correction mode. Last, the euro. Today's action puts you with the swing line down, lower highs, lower lows. However, you're still over the 18-day average, so the bias is up, and momentum is overbought trying to correct. I don't see a darn thing there. These markets now are full of the volatility. So, one of the things I do is I put out at 5:40 in the morning, I typically record my morning futures. And I'm talking these stock indices. I don't know if you're aware of it, if you're an ETF spider trader, that the futures, you can trade them on 1/10 size contracts. So instead of taking all the risk, you can cut it down, log yourself in. In other words, you can build positions, come out of them. And the commissions that most of the firms charge, well, it's pretty small. It's $1. Now you're going to say, hey, I trade for free at XYZ firm. In stocks, you might. You're not doing it in futures that I know of. If you are, let me know. I'd like to know, but I don't believe it. Just a lot more expenses in the futures, not as big a game. And in the futures market, there's no revenue coming back from an order filler. You do realize that order execution gets paid for in the stock side. How do you think they pay for all that? You don't have that in futures. So it's a whole different type of game. I owned a stock firm, so I think I know what I'm talking about. So when you look at this, you take a look at what's going on. 1/10 the size allows traders to work themselves in. And we have brokers that work with you. They walk you through this, what's going on. You get your feet wet to see, is this something you might like? That becomes the game. May not be, and it might be. Some traders want to build positions in these over time. We talk to you about it, and if you don't want to talk, you can learn about it by going to our website, / push this in when you go there, type it in, micro. That micro part explains how the micro futures work, the costs associated with it, and away you go. I'm Ira Epstein. Thanks for watching. Give us a call if you want to learn more, and I'll see you tomorrow.